All right, so thank you very much, Petros, and a big thank you to all the other 3 speakers of the second round. This now concludes the formal part of our Capital Markets Day, but before we start the Q&A session, I hand back over to Oliver for some closing remarks.
Yeah, thank you very much. I would like to put a lot of these pieces into perspective so that you get a consistent message. And I'd like to start by saying you now got a view this morning into an amazing engine that is Allianz, that is trying to do something that hasn't been done before, which is to create true scalability in the network across the enterprise, both as you saw in small markets and in very large markets, the most important market that is our home market in Germany. Now, let me take a little bit a step outside of Allianz and put this whole thing into perspective again so you understand what really the equity story is. What is very important, because you can ask yourself question, is to demystify the stories that you see also in other equity stories. The story is Europe is shrinking, motor insurance is disappearing, there is no money to be made in home markets, let's all move to China. Yes, there is growth in China, but there is massive opportunity for value creation in mature markets, and Allianz is going to be a leader in doing that. And that means we do what we know what we do, and we don't have to hope for political environments, for buoyant markets, for friendly politicians, for benign regulations, or markets that help us where others have been hundreds of years and we are a new entrant. We are focusing on what we know and what we do, and we do that too. Second, people are saying, well, it's not just margin under pressure, there is no growth in mature markets. It's just not true. In a market that is polarizing between the winners and the others, we are intending to take shares, both in terms of customer satisfaction, in terms of margin, and in terms of customer share, on the back of something that we know better than others. And we have the portfolio that others would like to have. And the last thing is, and we say it with all confidence, we have created the technical environment over the last few years to be able to do that, so we're not distracted by huge integrations, by having to bet on benign capital markets, on benign natural catastrophes, on benign growth in China. Just look at what happened to the FANGs and the tech stocks the last year. You know, if that ever happens to some of the financials in these emerging markets. Now, we do reallocate resources to growth markets. Some of them are right under our nose, whether that is clients moving digital or into new ecosystems. Some of them are indeed Asia, where we are playing catch up. There is no question. But guess what? When the Chinese government had to think about who they want in their country with the first holding, they didn't look at the obvious candidates. They look for people that think 30 years on, and they bring them in, because we don't want to be big for revenues. We don't want to be big for accounting earnings. We want to be big in terms of impact. And therefore, we are carefully allocating capital, and we will be profitable. So what you will not see is super expensive acquisitions to buy this distribution or joint ventures where all of the value goes to other people. So we will organically move the portfolio to where the growth is, but in a way that doesn't disrupt the earnings power of this group. That leads me to the fact of capital management, again, because there were questions. In 2017, and Giulio showed it, we paid out 94% of the total cash generation. In 2018, we paid out 90% of cash generation. There is no reason to think that we are going to change our policy going forward if we cannot deploy the capital to grow our global franchise. That is what we have done, and we'll do it, but we are no ATM. We're not just going to overpay and pay out just to make somebody happy for an overnight tick in the share price. We are going value for those that want value to grow. Thank you very much for listening.
All right, so thank you for your attention and your patience so far, and now we are very happy to take your questions. Do we have the microphones? Then let's start at the front row. Ulrike, please, let's start Michael first. And then we work our way backwards.
Thank you so much. And I heard one of my colleagues say these half days are fantastic, and I agree. The first question is, so your contract's been lengthened to 2024. the impression I have from today's presentation is that the 2021 targets you're giving us are kind of almost like a taste of what you might achieve in 2024. Is that right? Is there a sense that there's a lot more growth to come later, you know, in the plan? Because some of these things that you presented today will not actually hit earnings until afterwards. So I'm thinking about the new business value. I'm thinking about some of the direct stuff. The second question is much more simple. You know, in Allianz, we used to be used to 500 million of capital release from the shrinking of the back book. And that helped drive the payouts and stuff. And I was just wondering, has that disappeared? That seemed, and the last one, and is really the obvious one. Could you repeat the idea that we no big deals? I think, you know, you say complexity versus simplicity, but from the point of view of conglomerate discount, if you could completely rule out big deals, your share price would go up massively.
Can I immediately start with question 1 and 3, and then Giulio does also question 3 and then question 2? Is that a good? Is that a good one? So on the first one, that's exactly right. We have decided, particularly given the massive polarization in our environment, just think about society, rich and poor, the tensions we see from populists and all of these things, that we need to set the business model for the next 10 years and not for the next 3 years. And that has huge implications. And we've carefully analyzed. Think about digital. We had made an explicit point today not to talk about, you know, digital startups. You know why? We are learning that these technologies are super important, but they're playing out totally differently than all the forecasts. So when you Google, you can take our margin without being an insurer because you just auction distribution capacity. But so I'm not afraid of Google becoming an insurer, but we are thinking through how do we get client control, and that means by being the best of where clients want to go. And we are growing there. It is about, you know, acquiring people in the net and bringing them onto the platform that gives them the most value. So we're building it for the very, very long run. But the key thing is we need to prove we can scale. We need to prove that we're not just acquiring businesses and integrating them and saying I'm shifting portfolio from life to P&C. That is a short-term trick. The long-term trick is to prove to investors we can add more value than the local best practice. And that is to be done. And then you can scale. By the way, that also pays into your M&A question. It's not just being clever on timing. When we acquire or do partner, take LV in the United Kingdom, which was an extremely important transaction because it both proved that you can convince the oldest frontier society in UK to partner with us. It was also on very favorable financial terms. But the key message is it's not an asset. It's part of an ability to scale a capability globally, which we have not proven as an industry. So it's the latter one. Now, on the very large ones, you know, you always make a mistake when you rule out something, but I'd like to go back to the principles that we've set ourselves. If somebody came with a big idea, how can we then justify that if we can't prove we have all the integration risk under control, that the returns are being met, you know, that we know what we're doing, that the capital is there? So by definition, anything that is beyond a certain size is going to be very, very difficult to execute. Very difficult to execute. And that's why, for example, we said we are not going to buy something large on P&C in the US because what you have to pay to relative to the synergies we create for the foreseeable future will be very, very difficult to do. So I don't want to ever say never do never because you don't know what's going to happen, and then you will say, you know, honesty matters. And I've learned the last few years that telling people what you're going to do and then doing what you tell them is very important. But you can assume we are going to be extremely careful with your money.
The other question was about the solvency evolution, the life side. It has not disappeared, but it has reduced. And the reason for that is, as I said also in the quarterly call, we were not including in the past in the business evolution Allianz Life, because Allianz Life was not part of Solvency II. Now we are including that. This is not a big amount, but it can make 100 million compared to the 400 million that you are referring to. And also we are growing a little bit more compared to the past. So I would say the business evolution of 400 million minus for life is now more about minus 200. That would be my guess. But that's also important. I don't know whether it really matters considering that, you know, we have a solvency ratio 230 and general business evolution 10% per annum. So, but to your point specific to that, yes, it's a little bit lower compared to the guidance we gave you before.
Maybe you can say something about the new business value transformation into operating profit in life, because that's
we are definitely looking into that. And as you see, you know, as we move into the midterm, you know, phase, which is beyond 2021, the earnings are going to pick up, because right now we are running at a value in the business which is about 2 billion. That was not the case a few years ago. If you go back and you look at our new business value a few years ago, that was significantly lower. I tell you, we had a new business value even of 1 billion. Now the difference is, to be fair, that new business value, you could have applied a multiplier of almost 4, and now you need to apply a multiplier to get to the operating profit of 3. But still, if you are running twice the amount of value in the business, even if the multiplier might be different, at the end of the day, you understand that the value accretion, the operating profit accretion is going to pick up as we continue to put VNB at this level.
And we are working on, Michael, on making that much more transparent in the sense of when is the VNB materializing in earnings relative to expiring business. So over the next 18 to 24 months, you will get a pretty precise picture on that.
Yeah, maybe I want to say something. I don't know if you are going to get the picture. For sure, we're going to get the picture, because at the end of the day, the point is the following. When we talk about value in the business, I think we are sometimes we are not putting the emphasis that we should put, because value in the business looks like something exoteric. But if we get also for internal management conversation, the sort of, if you make 10 million more of value in the business, this means 3 million more operating profit in the next 2 years. If you get 100 more, it means 30. I believe we are going to have different conversation on driving this KPI. So it's definitely something that we are going to develop internally, and then this is going to help us also in the conversation with you guys. But that's really about driving the business internally.
Okay, Ulrike, we stay in the first row. Jan, yeah, this gentleman over there. Thank you.
Thank you. John Hocking, Morgan Stanley. I've got 3 questions, please. Firstly, on the resilience of the balance sheet, Oliver, you specifically referenced the volatile outlook. And I remember that the previous plan, there was a specific initiative to reduce the interest rate risk from the life business. I just wonder whether you've done anything or plan to do anything to make the balance sheet more defensive, given your view of markets. That's the first question. Second question, just on the EPS targets. You've got very strong organic growth in the P&C business, and you've got the productivity improvements that you mentioned. I'm just wondering why that doesn't feed through to a bigger EPS contribution from P&C into the group target. So mechanically, yeah, you could probably get to more than 4%. And then just finally, the legacy. I just wondered how quickly the legacy will be retired, and whether that's feeding into productivity targets, and to what extent is that just retail P&C and commercial, and whether there's some in the life as well. Thank you.
With the question about the balance sheet and the strength, if you want, of the capitalization level. And you are referring specifically the interest rate sensitivity. We have a target, and the target is to have an interest rate sensitivity below 11%. Right now, as of Q3, we were at -7. So at the end of the day, our strategy is to run a sort of duration match. So the only sensitivity we are picking up in reality is coming from the convexity. So from that point of view, clearly we are looking at the resilience of our balance sheet to shocks. And this goes beyond, in reality, interest rate sensitivity. That's also about credit spreads, and that's about equity markets. So from that point of view, we have a risk appetite. And based on this risk appetite, we define what kind of interest rate sensitivity can we absorb, what kind of credit spreads sensitivity we can absorb. So that was the question on the capital side. The other one was the translation of operating profit in P&C, and if I understood the question, into EPS. Yeah, absolutely. I would say if we have an operating profit growth in P&C of 5%, I would say that the translation into EPS, I will go pretty much at the level of about 7. So this is contributing clearly on top of what life is doing. You can almost apply almost the same multiplier, I would say. You saw the 3% becoming 4 to 5. I would say on the P&C side, the story is not much different. And you,
Can I say something about risk? Because that's this. We have systematically worked on reducing tail risk in the book. And in difference to other companies, we have found that given where we are, also in terms of profitability, never forget the other components. Selling back books or something is a risk and an earnings question. Selling as something at a loss and then, thinking that you've improved ROE going forward from an economic standpoint is not the right thing. And so, as we showed you earlier, have 93% of our businesses making a double-digit return on equity. Our need to really sell back books, either for risk or for return reasons, has dramatically declined over the last 3 years. And I just wanted to mention that. So both the earnings power and the risk profiles. Now, do you still have the volatility from the artificial risk that we don't economically have? That's the credit spread. Because we are making sure through reverse stress tests that we do not have a true economic exposure. And let me clarify that. The true risk and spread risk is liquidity risk. Right? Do you have to sell ever a bond at a discount? That, unfortunately, is a question that Solvency II doesn't ask. So we really focus on making sure never having to sell a bond at a loss. That is what we focus on, something that's not in the model. And that's why we maintain such a high buffer of capital and liquidity. And you need to understand that has a price. We see that. And given, and that is what people don't look at, the strength of the balance sheet, a 13% ROE at Allianz is a very different number in other balance sheets.
Okay, next, perhaps we move to the right. Could we have, this Andrew, this gentleman over there?
Hi there, it's Andrew Ritchie from Autonomous. A couple of questions. Just for Giulio, I think the implication is that your interest rate assumptions assume no change in yield curves from this point. Therefore, I'm assuming your EPS encompasses some ongoing decline of running yield. If you just clarify that. Secondly, on slide B16, in Ivan's presentation, there was an expense ratio you gave for the European direct business. I think it's 12%. Just to clarify, is that an all-in expense ratio or is that excluding marketing expenses? It seems pretty low. On SME, I mean, the biggest SME market is the US. It's about $100 billion of premium. And there's not that much innovation there right now, and quite a lot of greenfield insurers being quite successful. Would that be an area that Allianz would consider exporting its SME revamped product into? And the final question for Oliver, your NPS is set relative to the industry in each country, but the insurance industry is a terrible industry. And is that ambitious enough? Isn't it? Shouldn't you think about NPS not relative to a pretty bad industry?
I don't think NPS is terrible everywhere, but I think it's a fair observation that there are markets where other industries have much higher customer satisfaction than we have. And it's a very fair observation. But it starts, we would like to sort of walk before we run. So the number one is, and let me go back to where we're coming from. And you can call that embarrassing because the benchmark is not the right one. In 2014, only 47% of our businesses, we count P&C and Life separately, had a net promoter score top down that was better than the market. So you can also be very self-critical and say that was less than half. And that is taking the traditional competitors. By the way, most of them that are at the top are mutuals because they have a very effective way of thinking about that. Today, that number is, as of 9 months, 71. It's going to be 72% where we're above. We have only 4 businesses where we actually went back for various reasons. And we intend to really move to the industry. That is the first step. And then we need to move. The second one, and Nick had a question, Graf, how do you actually measure that? I'd like to also point out to the fact that we have an independent group of agencies that do get these numbers to compare us to traditional and non-traditional competitors. And as these numbers are targets for management, we get them independently audited. So the numbers that we do have, and we can show them relative to the ones, are real facts, not self-measured numbers, because you may get from other people we are also great. And the second step, and that is very important, these things that drive the NPS, i.e. the willingness of our clients to recommend, are the most important ones. There's perceived price value perception, the quality of the product and the service. That is really, really important, and the power of the brand. What we've learned the last 3 years, and that has made a big impact, that we have under-invested in communication to our consumers. We have over-invested in commission. And we have under-invested in the value perception of our products because people do not understand how good Allianz products really are. That has been one of the biggest movers next to improving underlying products. So the upside that we see from getting this right is massive. And that speaks to your point to where the benchmark should be. But again, let's walk before we run. Yeah, and let's get to where we need to be. It's Michael earlier said it's a 10-year journey. It's not a 3-year sprint. Now to the other questions. Yeah.
So when we do our projection regarding interest rates, we use a different approach for the insurance business compared to the asset management business. In the insurance business, we are pretty much assuming the interest rate level of June, and we just say nothing else is going to happen. So it's pretty much flat on the level of June. And we would move this level only if there is a big change between June and the planning period. So that's what we do on the insurance side. In asset management, especially in the case of PIMCO, we are assuming some sort of increasing interest rates. And this explains why the assets under management growth is 3.5%. You would expect more under sort of, stable condition. That's because we are assuming some sort of drag coming from a higher interest rate level.
So there was a question on SME then. Conceptually, that's exactly the right answer. Unfortunately, until 2020, this is Allianz is honest where we need to be honest, we're still working on the IT platform for the old Fireman's Fund business. As you know, we're operating through AGC and the Mid-Corp and SMB business, so we will not be ready for the next 18 to 24 months until we fix the IT. And I think that's really, really important. Now, do we say the opportunity is over by then? We don't think so. But let's get the infrastructure ready, and then we'll move from there.
Okay, I can pick up the question direct. The 12% includes all the cost, so also marketing costs and so on. Now, it's not that we have invested a lot in pushing the direct operation, especially outside Italy. So from that point of view, is the expense ratio of these companies, but you might assume that there was some underinvestment in marketing.
This is the target expense ratio. It doesn't include at the first stage the change of brand, and it's a very ambitious target because it depends on achieving a deep improvement in internal expenses and in acquisition cost, both.
And that also explains a little bit your question of why are some of the productivity gains not feeding through. We intend to use a significant part of the massive improvements productivity to reinvest in growth. And that's why you see also organic growth picking up, because it, as we said, communication in the brand, the empathy of the brand, the value proposition is something that we have to get better at.
All right, let's go to the middle here, James, and then Nick afterwards, okay, to keep it simple.
James Shuck from Citigroup. 3 questions from me, please. Oliver, around the scalability of things, which all sounds very sensible, and you've given plenty of examples today of where that's going. It seems to be that the evolution of the company is going more towards that of a service center. I'm just wondering what the natural extension of that scalability is. Do you start to offer your own products and services to third parties as a revenue and income stream in order to accelerate and grow even further that scalability? Secondly, just on the US, obviously, you make a lot about being global scale. US P&C is somewhere where you've had a mixed track record and you're currently not there. At some stage, do you make the decision that you might look to grow there organically, leveraging the scale that you've been talking about? And final question was just around the actual price point that you're trying to target for customers. So I'm interested to know to what extent are you actually able to maximize your margin through kind of halo type effects and better servicing rather than just productivity type gains? Thank you.
I would like to actually also allow some colleagues, and I haven't thanked the team here, who is carrying a lot of the work, right? You always look at us, but the reality is the people that deliver every day sitting on the right-hand side, and let's include them. Let's take a simple example of scalability. Why did ADAC move to us, right? If we are already the biggest guy, why do you have someone with a strong brand, a proud background? Because they want a partner that can help them to scale. So you've partially answered your question in the sense of that is exactly what is happening now. Why do banks come to us that have normally given the business to 5, 6 different providers, are coming to us and says, we want to work with you globally because you can actually ensure product, service quality, scalability of services. Last but not least, we are by design, not by accident, the largest assistance company in the world. Everybody's trying to say, we're moving from payer to partner, but the reality is, who is there? It's us. Example that we do. So it's exactly right. Now, are we where we would like to be? Let's go a step back. The operational delivery has to be outstanding. So the question about the US, yes, but we need to be honest and transparent and say, is the operational excellence in the US P&C business where it needs to be? No, it isn't. And until it isn't, we will not allow it to scale. But guess what? The first 9 months after we've rejigged some of the platform, the growth has been already 8%. Right? So the areas where we are really good, the brokers are coming to us and bringing us the profitable business that we are seeking. But we're not ready everywhere yet, not yet in the US.
On the pricing, maybe a comment, Oliver, if you allow, because I think it is important. Growth, we always see it as an acquisition of customers. There is an element in growth inherent to our pricing capabilities and our pricing techniques. And we have been observing the last few years by screening properly our pricing positioning in the market that there were cases where we left on the table some euros for no reason. We were less expensive than the next competitor by 10, 15 euros. And this was something that the market was appreciating, but the market also was willing to pay to us another 10 or 12 euros without disrupting the relationship with the customer. This is something that now we are doing it much more, let's say, meticulously, analyzing our pricing position, not only in terms of being the cheapest or the more expensive, but understanding also the dynamics, the comparable dynamics to the other players in the market. And there is an element of growth behind this exercise, indeed.
Okay, let's continue with this gentleman in the middle, Nick.
Nick Holmes at SocGen. Just a couple of questions. The first is, Oliver, going back on to the subject of Asia. I know you articulated the old world argument very convincingly, but Asia is surely a key part of scalability and a global platform. And it's been conspicuously absent, I guess, in your plans that you've outlined today. So I just wondered if you could elaborate more on where you see your Asian franchise going. In particular, China. There's been a very interesting development there for you. So that's the first question. And the second question is just looking at the expense ratio. Very good that you've targeted 27.5% for the P&C expense ratio. But, you're almost there, aren't you? And I just wondered whether that's a bit kind of being conservative, whether you think realistically you could deliver more on that. Thank you.
Now with the expense ratio, I would say, okay, we are not almost there because we still expect the expense ratio for 2018 to be above 28. So it's still some improvement, yes. But yes, the answer to your question, can I see the number to be below 27.5? The answer to your question, would be potentially yes. And then there is also a point that Michael has raised. He was saying, look, almost, Oliver, you are preparing for the next Capital Market Day in 3 years. I believe a lot of things that Ivan and the team is doing, they are going to also kick in down the road. So I would also say that 27.5 is anyway not supposed to be the end of the story, and then we can debate about the timing, but there is more to come.
Nick, you always ask very good questions on, where the gaps are, and you're right. You're right. I'd like to have, however, without deflecting, I'll talk about it, the fact that growth is at home and under our nose. And we'd like to we made the same mistake. We always said, let's go somewhere else, and let's not find it where it is. And when you really study granularity of growth, even in a market that top line grows 2%, our pockets are growing in value 4 or 5, 6, 7% a year, that we need to capture. So that's the first. So no more excuses at home. And Klaus-Peter was very clear, after 16 years of declining customer numbers, it's unacceptable. So let's start there. No excuses. And don't accept excuses from anybody else. Second, don't forget the United States. We have more than 3 billion operating profit. We have an amazing asset management franchise in the United States. The United States is going to continue to do well. We have a life insurance company that after 2008, you nicely always pointed out to the improvement potential there in the past. We've made extremely profitable. He was the CFO when we came and said you need to have double-digit ROE. He was thinking about where to move. Now he made it happen. That's why he's here today, by the way. One of the reasons. So we have $1 billion earnings coming from the US also on the life insurance side. So for that, and then asset management and life together, then you have all kinds of other issues coming on top. So we believe the US is super important for us before we get to Asia. So we have more earnings potential at home, more earnings potential in the US that has already 25%, and then we can do more. We just need to get the timing right. And then we get to Asia. The honest answer is we are still playing catch up. We're playing catch up to many other people. We started early in early 90s, and because of many reasons, internal, mostly in capital market, we lost touch, and we are rebuilding our position very systematically, very systematically. But before we go to you and gave you a great Asia story, to be honest, we needed to fix the basics. Now, we have tripled new business value in the last 3 years. George Terzariol, who I'd like to mention with his outstanding team, has tripled new business value. We were not properly present in the life insurance side. We had issues in China, left, right, and center from old joint ventures. We've cleaned it up. In Thailand, we've just changed the shareholding structure. There was a lot of cleanup to be done, just to be very transparent. Now, we've said we're sowing the seeds not just in traditional business, so in the life business where we have been overtaking in terms of APE growth, even some of the large incumbents. So please do look at the number in terms of both relative and absolute growth of Allianz versus the peers, even the dominant two. In the markets we operate, Indonesia, Thailand, others, we are better than them. What is the disadvantage we still hold? We are not strong enough in the mega cities, so that's Hong Kong and Singapore, and I don't see a short-term change to that. So that's why we have said, okay, what is going to open up, and that is China. So in addition to totally changing what we're doing on the life side in the past, because we said we want to do it the right way. So what is the wrong way? One, being a small partner in a huge bank assurance transaction where you show earnings, but you never see any cash because everything goes to the bank. The other wrong way is to grow in the wrong products that have massive tail risks in terms of asset allocation. Right? China is a very difficult and dangerous place in terms of the life insurance products there. So we don't want to do that. That makes us forgo growth short term, but ensures that we have a viable business long term. So what do we do? The first thing is we said we do want to jump S-curves. We do not get in traditional motor insurance, but we partner up with JD.com in order to create something that is truly scalable in the new world. And they're the equivalent of what Amazon is in the United States. The second one is to say we want to bring asset management and our other products like credit insurance fully into China. Therefore, securing the first ever insurance holding license was absolutely critical for us because it is going to allow us to bring all our businesses, including asset management, onshore, and then being able to decide who do we actually partner with. And we are working on exploring further options now that the government has clearly communicated to its own country that Allianz is highly welcome and preferred. And I can tell you we have lots of opportunities. But let's please talk about it once we are delivering, not to promise something that ain't there yet. Thank you.
We keep this for the next Capital Markets Day. Okay. Let's continue the second row, Vinit, and then afterwards, Peter, okay?
Yes, hi, this is Vinit from Mediobanca. So if I may, two questions on simplification, one for the operational side and one for CEO, and one question on PIMCO, please. So 3 total questions. So first question on strategy, on simplification. I seem to remember that it was 5 years ago that we were discussing the German story in the P&C side. And one of the real top takeaways was the modularization of the P&C product. And that was supposed to be a key driver. Now, if I look back at the German numbers, they seem to have delivered. So my question is that, are you trying to fix a problem that isn't there? Or are you upsetting a very nice functioning product suite by having this only one motor product or whatever else is happening? So that's a question for the German motor, essentially. Second question is just, if I look a slightly longer historical perspective, Oliver, started with the subsidiaries being incentivized to give capital back to Munich. And now it seems that the subsidiaries are being incentivized to also take products from Munich. And I know Petros said that there is a collaboration, and any comments would also be useful. But is there a risk that you're demotivating the rank and file by forcing down this or taking away so much power away as it looks like from the outside? So these are 2 strategy questions. And one question is on PIMCO on slide C8 of Giulio, that one of the last assumptions, which seems to be very critical to me, is stable markets, etc. Is it not an assumption that PIMCO's product suite, which you had updated us in 2015 CMD, the product suite, is it a fair assumption that it is a bit more able to manage in a very volatile or reasonably volatile environment? Because, as you know, you rightly said, the market's looking pretty tricky, and to assume that PIMCO will be stable markets is quite different assumption then. So just want to understand if the PIMCO product suite is giving you any more comfort on that. So thanks very much.
I would like to have the CEOs answer the question of whether Munich is shoving down something their throat.
So if you take Allianz Germany, on the P&C side, we have lost in the last 10 years 1.6 million policies. I think that's a lot. There were years where we almost lost shortly below 1 million. Now, that shows that modularization in itself does not help. You need to have the building blocks that I showed in my second slide. And the building blocks, they go onto the simplification. And the simplification in the end has the 2 medals. It brings the expenses down. On the other hand, it gives more customer centricity. Then there's the part about technical excellence. And I say here we have really made a major catch up with our pricing capabilities. And last but not least, also the sales excellence is coming through. We are much more effective on our sales networks than 5 years ago. So I would say that really makes the difference. And the motor is just the beginning. Thank you.
Yes, I would like to add that the ACM, the simplification model, is something that came up from the bottom up, through experiences with companies and through the support and additions that the CEOs have added and brought to the concept. So it is fully assumed by the organization, and I think that everybody understands now by Allianz not only the language, but also the fact that we want to really make something out of the group.
And then, Ivan, if you allow, I think it is important for us to understand that in the commodity world, simplification is a must. In commodity products like motor and property, there is no question about simplifying at the limits of what simplification can be. And there is no reason of doing it in a country-specific way, since the modules are clear, the needs are quite clear as well, and therefore the package solution is the only one that would drive simplification, not only in terms of selling process, but primarily in terms of IT infrastructure that you need to support this, where we have all the important benefits in terms of an expense ratio and earnings then.
change. We used to have what we call the Allianz target model that was developed with the people but out of the Munich. The product comparison that Ivan did, Klaus-Peter did when he was in Italy, Joachim Müller did in Germany. It was the CEO saying, what is the similarity? And then learning that, by the way, the biggest resistance to change is not them or us, it's in their own organizations.
The question on PIMCO, the resilience of the business model. Clearly, we've been working on the resilience of PIMCO, and there are two ways to work on that. One is also try to diversify into strategies which are not necessarily fixed income. And you're working on the margin here, but that's something that we are doing. And the other one is also within the fixed income, you can have different strategy. So I would definitely say there is more resilience compared to what we had before. But at the end of the day, there is still exposure to volatility in the bond market. Another consideration also, as you are thinking about diversification, you might diversify even more, but this comes at the cost of scalability and efficiency. So it's all about finding, if you want, also the right balance between how much you want to diversify, but on the other side, that there is also a benefit in driving scalability and efficiency. But the bottom line is, yes, there is more resilience today compared to the resilience we had a few years ago.
No, Oliver said and told me just you had questions on demotivating people because of capital upstreaming. I would like to sort of take that a little bit because it's very important. Remember initially when we said that we have in the past set targets based on budget, and people would come and say, the market is soft, life is tough. Last I gave you X, this year I'm giving you X minus 5, and then we negotiated. And sometimes we came back and said we actually accepted that, no more. This is super important to understand. We are all incentivized to deliver a certain ROE and to grow the earnings. And that is true not just for the portfolio and everybody. If you do not produce the earnings growth, we then obviously are going to ask, well, then we want the money back, right? By the way, we have yet to receive a convincing case of earnings growth and investment startup that we haven't supported really fully. So it's not that we don't want to give the money, we have a lot of it, but we need to really focus that it's not just about protecting earnings, but growing the business. That's the CEOs and all of our jobs. So I don't believe that's the case. It's just making sure that we beat the benchmark, and that is not easy, and you grow the earnings. And everything, again, that we don't need, we bring not just to the center, because we don't want to sit it, we give it back to you. So we have the commitment to bring the capital there where it's productive. And if we cannot use it, we give it back to the shareholders.
Okay, Peter, and I think then we move afterwards to the next row. Thank you.
Thank you very much. 3 questions, please. The first one is for Klaus-Peter. It seems that quite a big part of the German turnaround story has been the garage steering, which I think I'm right, the rest of the German market had already been doing a little bit ahead of you, and it's fairly common practice elsewhere as well. I'm just wondering what the reason was for being a little bit behind the curve there, and other things that that maybe you can improve, that you're not quite... there are still areas to improve elsewhere. Second one is for Lena. On the when you mentioned taking prices from other countries, I guess different countries can always have different characteristics, and there's a naturally sort of alarm bells ring a little bit. But I'm sure you've got controls in place. I'm just wondering if you could talk a little bit about what those controls were. And the third one for Oliver on the. I'm not sure if I fully got the message, but my understanding was that you seem to be talking about sort of insourcing insurtech operations a little bit. I guess peers will highlight that the entrepreneurial nature of insurtechs needs them to be apart from the industry, and that ownership doesn't really work. Just want to understand whether you have a different view there, or perhaps you could just explain what you were thinking of there. Thank you.
Yeah, I think the reason why garage steering was not activated the way it should have been, it was underestimated how much potential it bears in there, not only expense ratio wise, but also from a customer satisfaction point of view, and that's what we really see. And we will continue this journey. But if you look at the motor product, it has many new features in there. Also service features. I was talking about the premium roadside assistance that has a very, very high penetration now, and we get a lot of satisfaction. So the whole product had been redesigned. We reduced it from 13 modules to 9 modules. We did not only kick out modules, but we renovated them. And behind everything that is really the core is our real-time pricing engine. And I think that makes the difference currently in the German market.
So to the question of taking risks around the pricing on the SME side then. So when you start something new, of course, you need to start and you do take a risk. And that's where I think being a part of the Allianz Group and the scale of Allianz Group helps. So what we're specifically doing in Austria is we're using the data from the rest of the countries that would have data. And of course, we're also checking how the Austrian market functions and all of those modern things you could do. But I think the third thing that's helping us a lot here is the new technology stack for pricing, which has partly been mentioned by Klaus-Peter several times, which is we're rolling it out globally now. So we write business one day, the day after, we would then have an overview of what happened. And if we see things happening which we didn't expect, we can actually change the price the day after. So we have a very agile pricing technology in place, which gives us the opportunity to correct. And we will probably do quite a few of those things, because when you start new, that's normal. So that creates this agility in how we can build new businesses going forward.
So the question was left on the InsurTech. What we wanted to say is the following. Because of what we have done with creating Allianz X, which in of its nature is the largest investment fund in these startups, we have been investing in various startups like others that we try to focus on those that are successful. What we are learning is the following. We are learning, yes, do you need the entrepreneurship and the change, but what they all lack is scalability. Because what you need to make money in insurance is not a smart front end, but you need an integrated business model that actually delivers. So you need both. You need the entrepreneur. So we will continue to have both. But the idea, again, is how can we scale the innovation into our businesses rather than keeping them separate? And this is what I wanted to say.
Dhruv, you still have a question? Okay, sorry. We stay in the second row. One last question from the second row. Dhruv, please.
Thank you. Dhruv Gaylord, HSBC. 3 questions. Firstly, if I look at AGCS, that's been running at a combined above 100. Just wondering, as in, what do you have for AGCS in the current plan? Secondly, just following on your comments this morning on the P&C capital charge, you said that's between 35 and 40% of premiums. What would that number be if I was to look at new business last year on the life side? And lastly, you have aspirations on CE to grow revenues by more than 20%. Same, you're expecting growth in the German book as well. Could you say a bit more about pricing, as in how do you see the cycle at this point on both these markets? Thanks.
Let's start from AGCS. The combined ratio right now is about 100, and the plan is to bring down the combined ratio to 96. And most of the improvement will come from the United States. The other question was the capital intensity for life. Assuming we do 1 billion of premium, you can assume a solvency requirement of about 2% on the 1 billion of premium. So that's the number for the capital intensity in the life business.
With pleasure. I mean, our plan really foresees the growth focused on retail and SME. And these are 2 large segments that are not as cycle related as we would see this with the mid-corp business. In the mid-corp business, we will stay stable. So our growth is really focused on this part, where we find interesting loss ratios and where we find also the possibility to get our expense ratio down. So this discouples us also more from a cycle. What we have to say, compared to last year, yes, also this year in the motor market, we see already a more intense competition compared to last year, but we will have to wait until year end. then we can tell you more how the cycle in motor will continue.
And in our case, I would say there are 3 markets of focus where our scale today is below what we should have been running as a total book of business. One is Poland, where our market share is at 5%, and we clearly need to have a higher ambition, and we are working on that. Czech Republic, where also we believe that the P&C book of business range of 12% today, it should go above 15%. And then Romania, where we have a leading position, but primarily driven by our activities in property business and not in motor that much. We intend to be much more selective and proper in motor. In the overall performance of the book, I could clearly say that the combined ratio we aspire for the Horizon 2021, which is below 88%, gives already clear an indication on the profitability buckets that we have in the region that were quite significant. This is primarily driven by the lack of maturity of the markets and the techniques we apply in terms of technical expertise that would allow us to be much more properly selective than the competition. I always say to my colleagues when I visit the countries that when a loss-making business is leaving Allianz is a good sign, because this puts more pressure to the competitors and it allows us to be more competitive in the right segment. So we are doing this very simply and very professionally, I would say.
All right, now finally we're moving to the third row. Ulrike, let's start on the left side. The third, Johnny, the third gentleman there. Thank you.
Hi, it's Johnny Vo from Goldman Sachs. Just 2 strategic questions and 1 sort of financial. Just on the strategic side, just coming back to simplicity, I guess there's obvious benefits for you from a cost perspective, but I guess it does come back to the question of commodification of the products. And so ultimately, is this just a race to the bottom? And effectively, what is Allianz's ultimate competitive advantage on the long term? Is it pricing? Is it distribution and whatnot? Because usually, the tech is usually to support a competitive advantage. In terms of the direct platform as well, just to make clear, there is no differential pricing between the legacy and the platform. Is that correct? And then ultimately, is this an offensive move, a defensive move, or is it ultimately a stick to drive out efficiency from the existing business? And then finally, in terms of the EPS targets of 4% organic, that implies about a 1.5 billion buyback per year as a base case. But with the 1.
4% is just assuming is the growth in operating profit.
I know, but if we get to the 5, so it's 4 organic, and then the 5, so the 1% is 1.5 billion.
Yes.
So if the organic is higher, do we get a lower buyback and so forth? Can you just talk about the dynamic there? Thanks.
Now we look at the accretion coming from capital management. I just tell you right away, if you go for a pure buyback strategy, and you can take the 2.5 billion of cash flow, and you just say this is going to go fully in buybacks, I tell you, you can run the math, it's going to be more than 6% growth in EPS, right? It's mathematical. Now, if you go into more M&A, then clearly the number is going to drop closer to the 5%. That's pure mathematics, and the reason is M&A in the short term will never really beat a buyback because you have restructuring, you have all these kind of things. So from that point of view, an M&A richer strategy compared to a buyback strategy is going to dilute initially the EPS accretion. If you anyway make sure that in reality you are beating the M&A is beating overall the buyback over time, you're going to get the accretion back. But it's not going to happen in the first 2-3 years.
So the number is, as you asked, north of 6, depending on how you do that. But again, as is it, it's just mathematics. And again, assuming that we have a certain return target, the money will not sit in the bank for 15 basis points. Now, the second questions you had was, and I'll do it very quickly so we have some time, on the commoditization, what is the ultimate competitive advantage? It will come out of 2 things. First, being much closer to consumers in terms of what their value perceptions are. So even in so-called commodity perspective, you find for the strong brands and the strong service, 5 to 8% combined ratio advantage, which is massive in terms of capital consumption. And they may operate over time, and then there's scale coming from that. We have totally different branding power. So in a world where we will move from push, i.e. paying commissions, to pull, that is investing in branding and bringing clients onto our platform, scale will truly matter. So being able to build a strong brand and then reduce marginal acquisition cost, for example, by bringing warm leads to our distributor, will make all the difference. EPP pricing, maybe Ivan.
We will certainly apply in the European platform the idea of decommissioning the old products so that the portfolios will move increasingly to the new product, and most of the and there will be a convergence of the pricing. But this will come when we launch the new platform and have all the products and on the same platform, and we can deal with it. This will be in 1 year time.
All right. This gentleman over there, Farouk.
Hi, thanks very much. Farouk Hanif from Credit Suisse. Just two questions. On the ACM, I can see why, from a cost point of view and a customer point of view, it's really effective and radical. But from an underwriting point of view, doesn't it create local risks? So take whiplash in the UK or different bonus systems and fraud patterns. I mean, how do you ensure that it doesn't just look good from the outside, but from the inside it's profitable? And second question, going back to the fintech threat and why you're better. I mean, isn't scalability available because balance sheets are available? So if you get this entrepreneurial culture, take the hairdressing salon example. You know, if you can create the right app, you know, with the right relationship with your customer, I mean, you can borrow the balance sheet and underwriting expertise. So I was wondering why you believe that you're going to be better at this than new entrants. Thanks.
On the ACM, sorry, I don't know whether I understood you correctly.
The questions were by driving the ACM, we might lose some sort
of
discipline from an underwriting point of view.
Yes. I don't think so. I would rather put it the other way. First of all, the idea of making packages is, from a pricing perspective, price efficient. We homogenize risk and we reduce anti-selection. So the starting point is good. And then I do think that at the current point in time, pricing, we still can build up a competitive advantage because we have the new pricing tools. We are investing in technical excellence, and the pricing we can have the competitive advantage in pricing as well in risk selection. Not all the companies have the possibilities to count on the customer data that we have, and data analytics are a new field of exploiting and improving the risks, particularly the risk selection and the underwriting that may lead at the beginning for a competitive advantage. So I think that it is both, it can be combined, the package perspective in products with the right pricing.
And so simplicity doesn't mean stupid simplicity. It means smart simplicity because you hide that. You would, for an iPhone, you would not say this is stupid. A lot of the intelligence is just built into the product. Now let's talk about the startups. Now, we will see how that goes. I think the scale players are more relevant. And why? And I'll give you an analogy just from the German motor market. Admiral came, the best UK sort of direct insurance company, after a few years, they need to fold in and move home with a tail between their legs. Direct Line came, set up shop, Italy, Germany, they didn't move any. Why? It's not because of lack of capital that you can access. It's not lack for distribution access because you can pay commission or you can advertise. What you really need to do is to have the customer franchise, but more importantly, you need to have the infrastructure, the claims settlement network, the ability to negotiate with distributors in order to execute. It is not about regulation. It's building a system. Think about the competitive advantage in credit insurance. Is it about the credit risk algorithm? No. It's about the ability to collect and deal with debt collection and building a global network that can do that. That is what we call platform effects. So do not underestimate the power of having an integrated system that controls the most important value levers. And that is not so easy to replicate.
Okay, any more questions? Yeah, Thomas over there, please.
Thanks, Thomas Seidel from Bernstein. 3 questions on the slide C15, all on M&A. On the left-hand side, strategic fit. Last time I think we spoke in 16, you talked about upscaling in P&C in countries where you're already strong and buying in asset management for skill. When I look at it now, it seems like a broadening. Is this right? Are you broadening the scale here? First question. Secondly, on valuation, you talked about the hurdle being cost of equity. At the same time, you maintain the ROE target, which is a couple of percentage points higher. Does it imply that you cannot do a large M&A, which is ROE dilutive? And thirdly, can you remind us on the LTIP, what is the lower boundary on the ROE for your LTIP, and what is the weight in the LTIP of the ROE? Thanks.
Coming from the scope, no, I don't think we are changing necessarily the scope. That's not what we are saying with the slides about the strategic fit. So we are pretty clear that property casualty is where we have most of the focus. Then life, it depends what kind of life you're talking about, but clearly we're now looking into capital-intensive life businesses for sure, and asset management, we are definitely looking whether there are bolt-on acquisition possibility, which is what we said also in the past. So there is no change in this philosophy. With respect to the ROE, yes, you are right. If the ROE target is 13% plus, that's a little bit of a constraint on some large acquisition because there is a difference in reality. You know, economically, at the end of the day, you need to be the cost of equity of a buyback, and then the EPS is going to reflect that. In order to keep the ROE, it's a different story because you need to beat almost. So you cannot dilute too much the ROE of the group. So that's a sort of constraint. I would also add that I would always anyway remove restructuring expenses, all these kind of things from the initial calculation. So I would always look anyway at the through earnings as opposed to take into consideration also for what we know they are just one-off in the first years. And the last question, I don't understand what is the LTP or whatever, so I didn't understand the...
No, your long-term incentive plan.
Ah, okay. And what is included in the... Yeah.
The lower hurdle on the ROE and what is the weight in the LTIP, because it's not clear from your annual report.
I don't know.
I make it simple and then we take it offline with Oli. We have the same incentives internally that we have externally.
We can follow up on this, Thomas. I can give you all the details, no problem. Yeah.
By the way, we will over the next year change top management compensation and move it much more to shareholder oriented compensation than it is today. Today it's only 25%. That is actually the relevant observation. The relevant observation is 25% and it's going to go up in importance significantly. We can't talk about it now because it goes through increasing internal gremia. But that's a relevant one. I think it's not the hurdle that is important. I would like to talk one thing again about that you've mentioned before. The large dilutive deal. That is the question sort of on top of the question of Michael. Large dilutive deals we do not do. Is that a better answer, Michael?
Thank you. Okay, we are almost, the time is almost up. We do have time for a couple of more questions, but please keep in mind that there will be the opportunity for informal talks over lunch as well. But yeah, Michael in the back.
Michael Haidt, Commerzbank. Just one question. When I look at your operational targets, then combined ratio 93, I think it's it's a very brave target. It shows probably the power of the organization. When I look at your life and health target, new business margin, above 3%, you are already at 3.5% or close to 3.5%. Why are you so cautious here? Do you expect a change in the business mix, or is the 3.5% as good as it gets? Why are you so, compared to the other targets, asset management, P&C, it seems a rather cautious target?
Yeah, we're not expecting any significant change in business mix, so it's not just an indication that we expect to have some pressure. We just say once the new business margin is about 3%, at that point in time, we are looking more for growth as opposed to necessarily try to lift the new business margin even higher to a 4%. So if you ask me what we are going to see, we are going to see a new business margin under this condition, which is going to be more or less the new business margin of 3.5 that we are seeing now, and then the idea is to pick up growth instead of try to get the new business margin to be higher. So just look at this higher than 3 as is almost a threshold, and we don't want to fall below. But the expectation is to see new business margin at the current level also for the planning period.
Is that good enough?
Okay, we have time for 1 or 2 last questions, if there are any. If not, we say thank you very much for being here, for your attention, and let's continue our discussion over lunch. Thank you.
Thank you, team. See you out there.